Hello, and thank you for attending our webinar on establishing a compliance plan for unclaimed property. This webinar was put together by the National Association of Unclaimed Property Administrators to educate holders on how to create their own compliance plan. The webinar will start by providing a general overview of unclaimed property and delving deeper into our main topic on how to establish a compliance plan. The following subtopics will be covered today: internal guidelines for unclaimed property, review of books and records, due diligence process, preparing and reporting unclaimed property, and post reporting protocols. Let's start with a general overview. Unclaimed property is defined as tangible or intangible property that is unclaimed by its rightful owner. Common types include uncashed checks, checking or savings accounts, unpaid wages or commissions, customer deposits or overpayments, certificates of deposit, refunds, money orders, insurance policy proceeds, stock, bonds, uncashed dividend checks, and underlying shares, etc. The entity holding the property is known as the holder. A holder can be a business association, a financial organization, a governmental entity, a trustee, or any other legal or commercial entity obligated to hold, deliver, or pay property belonging to others. Mostly, all businesses and organizations will have unclaimed property at some point. Therefore, they have the obligation to review their books and records each year to determine if they are holding any due for reporting to respective states. In the landmark case of Texas versus New Jersey, the Supreme Court established the legal framework through priority rules to determine where to report the identified unclaimed property. The primary rule is to report the property to the state of the owner's last known address, and the secondary rule is to report the property to the holder's state of incorporation if there is no last known address of the owner. Since holders are required to report unclaimed property to different states, how should they establish a compliance plan to comply with state laws? A good compliance plan should set forth guidelines a holder should follow to become compliant with unclaimed property laws. Books and records must be reviewed, due diligence completed, unclaimed property reports submitted, funds remitted to the appropriate state, and post-reporting protocol established. Let's take a closer look at each of these issues. Holders are encouraged to establish internal guidelines to help prevent some common errors that generate unclaimed property. Record retention policies for specific records should be spelled out, and policies and procedures created to be used as a reference guide for internal use. It's important to provide proper training to employees who work on specific accounts that generate the most unclaimed property. Examples include accounts payable, accounts receivable, and cash accounts. In instances of high turnover or change of roles, train new staff members to ensure that they know how to identify potential unclaimed property and what actions to take. Keep a close eye on these specific accounts and save information in a format that will facilitate unclaimed property reporting. Prevent accumulating unclaimed property within an organization. By taking these steps, establish internal guidelines to avoid and catch mistakes, such as duplicate payments or overpayments, accumulation of stale dated checks, unresolved payments, neglecting to find the owner of a property, leaving cleared checks on outstanding checklist, failing to reconcile records on time, and poor maintenance of accounting records. In addition, holders should create an unclaimed property liability account to better match and easily identify property subject to individual state laws. Annually, holders should review their records for possible unclaimed property. Complete a thorough general ledger review and identify specific accounts with a higher risk. Review journal entries since most of the errors that generate unclaimed property are recorded in journal entries. Disbursement accounts and corresponding bank reconciliations should also be reviewed since outstanding checks are often written off or lost in these processes. Some of the general ledger accounts to review while trying to identify property include accounts payable, accounts receivable, payroll and employee benefits, miscellaneous expense, suspense, security deposits, income revenues, dividend payments, and any other accounts with a high risk. Holders are also encouraged to review credit balances in the accounts receivable, refunds due or overpayments, money orders not cashed, security deposits, etc. Pay close attention to the review for some of the journal entries, including entries to the wrong ledger account, reversing journal entries, year-end adjusting entries, and ledger account balancing entries. The majority of unclaimed properties are identified through the disbursement accounts review. Holders should review the open disbursement accounts, including bank account reconciliations and outstanding check listings. Closed disbursement accounts, including disposition of outstanding checks, write offs or voided checks, stale dated checks, and checks returned by the post office. During the review of books and records for potential unclaimed property, holders should understand that depending on the type of entity and industry, property types to be reported may vary. For example, banks may have checking accounts to report, while a hospital may have patient refunds to report as unclaimed property. Holders are required to make a list of all unclaimed properties identified and try to locate the rightful owners of properties identified before submitting any property to the respective states. Due diligence is the name for this final effort on the holder's behalf to contact an owner. Statutes and due diligence guidelines pertaining to efforts required from the holder to find the rightful owner of the property before remitting to the state vary. The holder should follow the corresponding guidelines for the states where the property will be reported. Some states may require that only mail be sent out as part of due diligence efforts, and others may accept other efforts such as emails and other acceptable means. In their communication to the owners, holders should include their contact information and a disclaimer to let the owner know that funds not claimed will be placed in the custody of the proper agency managing the unclaimed property program for their state. Once due diligence is complete, the remaining properties where the owners were not found are considered unclaimed. Be sure to organize the list of properties considered unclaimed in a format which facilitates knowing when a property has reached its dormancy and is due for reporting. Dormancy is the period of time when an owner of property does not take action on his or her property. The dormancy period varies depending on the type of property and unclaimed property laws of each state. Most dormancy periods range from 1 to 5 years, but some are longer. It is important holders get informed on what each state's reporting requirements are. You can review state reporting information at unclaimed.org/reporting, but we encourage you to review each state's website for additional details and guidance. For reporting purposes, not all the states have the same unclaimed property reporting deadline. Most states require holders to report in the spring or the fall, and insurance companies may have a different reporting date than other holders. As an example, if the reporting deadline is November 1st of each year, a property with a last transaction date of May 15, 2019, and a dormancy period of 5 years is due for reporting by November 1st, 2024. The file form requirements for reporting unclaimed property also vary from state to state. All states accept the NAUPA format, although not all require it. Holders should ensure that unclaimed property reports to be submitted list all the owner's detail information such as names, addresses, social security number or federal tax identification number, and any other known information that can help states in locating the rightful owners. Once the unclaimed property report is submitted, holders should ensure that the related payment is also remitted to the state. Post-reporting, holders are required to retain supporting records or source documents in case there are questions on properties reported. States require supporting documents be retained for 5 years from the date the report is filed, and this time period may vary from state to state. In instances where the owner shows up after the property was reported to the state, holders should advise frontline employees to direct the owner to the state to claim. If applicable, the holder can satisfy the owner and request a reimbursement from the state by submitting a holder reimbursement form. In conclusion, success in this area comes from taking a comprehensive approach, conducting regular reviews, and following established procedures diligently. By implementing these key practices, you're meeting regulatory requirements, contributing to your organization's commitment to your customers, and helping to reunite owners with their lost property. We encourage you to apply these principles and reach out to the state directly if you need any clarification or support. This concludes the training. Thank you for your participation.